So Unit 3 of the Evaluating Financial Information, the Advanced Higher course, and this looks at looking at financial information. Financial information is normally a question that appears in the case study where you will be asked to compare a business's finances over a period of 2 or 3 years, maybe even 4. And what you have to be able to do to evaluate that financial information is you have to be able to know about different ratios and be able to look at those and what happens when there are changes in these different ratios for the better or for the worse. So using financial information, then public limited companies are required by law to prepare and publish final accounts at the end of their financial period. This can be done at the end of the calendar year, the end of the financial year, or any time the business chooses. However, the date must be the same every single year. These final accounts give a historical record for that financial period, and the managers can see then what the business has improved on from the year before. Are they better than their competitors, or are there problem areas that they have to look at? And as we said last year, there are a wide range of stakeholders interested in a business's financial performance. In order to enhance the information given by financial accounts or final accounts, a business will carry out ratio analysis. And this is where you use a number of ratios to work out how a business is doing. And we're going to be looking at each of these ratios in turn and what happens if it's better or it's worse. And that's really important that you understand this. The ratios come under 3 different categories: profitability, liquidity and efficiency. And so ratio analysis gives you further information on the business's performance over a financial period. So what it allows you to do is it allows you to compare your business's performance over 2 time periods. It allows you to compare your business's performance with those of your competitors. It allows you to compare what you thought the business was going to do against what it actually did, and investigate areas where your business is not performing at all. So first and foremost, profitability ratios. Profitability ratios are just exactly what they say. They're going to analyse the profit-making capacity of the business and whether it's met its objectives. So we're looking at 2 different profitability ratios here. We're looking at gross profit ratio, which is gross profit as a percentage of sales, and we're looking at the profit for the year ratio, which is the profit for the year as a percentage of sales. So first and foremost, the gross profit ratio. This is used to calculate the gross profit. Now remember, your gross profit is your profit on trading. Your sales take away your cost of sales as a percentage of sales turnover. A high percentage may indicate the business has an efficient buying policy. In other words, they are able to buy products in raw materials, etc. at a cheaper price and sell for a much higher price. And that's what this says, or a high selling price compared to the purchase price of the materials. So the difference between the purchase price and the selling price is what we call gross profit. So the bigger that is, the better. So the change in ratio can be caused by an increase or a decrease in selling price. So if your selling price goes up, but you're able to maintain the cheaper cost price, then your gross profit is going to be bigger. If your selling price is coming down, maybe because you've got lots of competition and you have to do that, then the gap between your cost price and your selling price is going down, which means your gross profit is actually going to fall. It's going to go down. Another thing can be a change in the cost of goods sold, and that's something that's out with your company's control. So it might be your suppliers are putting their price up. If they put their price up, the gap between the cost price and the selling price is down, reduce gross profit. Or if they actually put their costs down, maybe because they're experiencing competition, then the gap between the cost price and the selling price is up, which means that your gross profit is going to be better. So the formula used is gross profit divided by sales multiplied by 100, because it's expressed as a percentage. The profit for the year ratio is very similar to the gross profit ratio, and your profit for the year is the final profit after all of your expenses have been taken into account. So it's used to calculate what percentage of their sales they've turned into profit for the year. Where a low figure is calculated, it shows the company's expenses may be high and should be further investigated. So if your profit for the year is falling, it could be that your expenses are too high and you maybe have to look into that. The ratio is often used to highlight efficiency and control of costs. So your expenses are a big thing here, and if your profit for the year is going down, then it suggests that your costs, your expenses are too high. How is it done then? The formula is profit for the year over sales times 100, very, very similar to the gross profit one. Now we're going to look at liquidity ratios, and these analyse how the business has performed over the time period using their assets and controlling their debts. So if a business is liquid, it means it has got cash available, money available to be able to pay off its debts. That's really what liquidity means. And the two ratios we'll look at here, which are once again very similar, are your current ratio and your acid test ratio. The current ratio is used to show the business's ability to meet its short-term debt. There is no ideal figure, although it should normally be as close to 2 to 1 as possible. So your current assets should be twice your current liabilities. Remember, current assets are short-term things you own, for example, your inventory, your bank account, people that owe you money, etc. Your current liabilities are your short-term debts like bank overdrafts, trade payables or creditors as we used to call them, people who you owe money to. So where the ratio is too low, so let's say for example it's 1 to 1 or 1.5 to 1, then this indicates the business might have liquidity problems. In other words, they may not have sufficient current assets to cover their short-term debt. Where the ratio is high, maybe it's 3 to 1, 4 to 1, it indicates there's more than enough money to cover your short-term debt. However, that might mean you're holding too much cash in your current assets, and that's not, current assets don't actually earn you anything. You're better turning these into non-current assets, buying machinery, buying equipment, things that can actually generate more profit for your business. So your current ratio really should ideally be 2 to 1. Any lower, then you've got liquidity issues because you can't pay off, or you might not be able to pay off your short-term debt. And when it's too high, you're holding too much money in your current assets when they could actually be generating some kind of profit for the business through you buying machinery or delivery vans, etc. Spare cash can be invested even in the short term and earn additional income for the business, and that's just what we're saying if your ratio is too high. So the formula is current assets to current liabilities, and it's a 2 to 1 type thing. Your acid test ratio is very similar, although it takes into account the fact that some stocks of raw materials and goods for resale can take time to be turned into cash. So for example, if you're a business selling foodstuffs fly off your shelves. That's your stock or your inventory, and it flies off your shelves on a regular basis. If you're a company that's selling something like antique furniture or grand pianos or whatever, then these do not shift as easily as you would like them to. So the result of that is you can't call your inventory a current asset because it's taking too long to sell it. It's the turnover time in actually trying to sell it is too long, so we can't do that. What we have to do is we can't call it a short term or a current asset. We have to assume that it's more longer term. The average figure for this is 1 to 1, and it should be used as a guideline, although anything less would show the business may not be able to meet its short-term debt, just as we talked about for your current ratio. Some types of business can operate with an acid test ratio of 1 to 1, so the typical ratio will depend very much on the business. It depends how they feel they can actually get their products to sell. You know, if you sell grand pianos, if you reduce them in price, do you know they'll sell quickly? Things like that. So the formula is very similar to the current ratio, but we do not include inventory. So it's current assets less your inventory to current liabilities. Your efficiency ratios now then. These analyse how easily a business can meet its debts, and your current assets and current liabilities are analysed here. Now what we use here is return on equity employed. Now your equity is your share capital of the business, so it's a ratio which is expressed as a percentage, and the better this is, the higher this is, the better. It measures how well or how badly a business has been invested. It has utilised, the equity, money invested by the owner that's been invested. This gives a more useful interpretation of performance than looking at the profit figure, because what it really does here is it says, well, what equity have I put into this business? How much have I invested in it? How has that changed into profit? So if you're investing a lot of equity in your business and you're not getting much back in the form of profit, then your business is not performing efficiently. Obviously, the opposite's true. So when you invest money in a bank, you'll probably pick the one with the best interest rate. The concept is similar here. The owners want to know how much their investment will earn in percentage terms. So if I'm putting this money into the business in the form of share capital or whatever, what am I getting back for it? The formula is the profit for the year divided by your equity or your capital, and once again it's expressed as a percentage. So what are the limitations of ratio analysis then? Remember, the information is historical and it becomes out of date very quickly, which means what your borrowing decisions might not be based on what's currently there. You've got to make comparisons with previous year's performance. They don't really mean much on their own. You've also got to make sure your comparisons are with similar businesses, same size, same industry, and that can be really, really difficult to do. Different businesses might not even calculate their figures in the same way. So for example, inventory figures are sometimes calculated differently in different businesses, and that makes comparison different. If used for comparison purposes, it's imperative that businesses prepare their final accounts according to the FRS, Financial Reporting Standards and Companies Act, so they've got to be created in a certain way. And finally, the external environment of a business changes from year to year, and these changes might not end up being reported. So for example, it could be over COVID, businesses weren't selling the same. So if you're comparing figures to previous years, you can't, because the external conditions were different from the previous year. It's the same with internal factors. You might have had a large turnover in your staff, you might have introduced new methods, and staff are getting used to it. So it might be, for example, that the turnover is not the same as it would have been before, or the profits. Annual reports are produced to coincide with the publication of the annual accounts, so they set out to show the business's success over the past trading period, as well as highlighting the programme for change. So what normally happens when the final accounts go out to shareholders, there will be a report from the managing director, the chief executive, etc., saying where the business plans to go. The report is aimed at existing investors who will be keen to show growth and sound decision making, but it will also look to potential investors to see if they would like to invest in the business. And it will also show employees how their messages and how things are going with the business and how the business is moving forward. They tend to contain, as I've said, messages from the senior management team about strengths, etc. And the wording and tone, you've got to be careful, because the chief executive might be rather biased and they might want to show that the business is doing really well to shareholders to get people to invest. So it's really important that they try to be as unbiased as possible, but that's not always the case. These tend to be, as I say, put on the company's website around and about the same time as the annual accounts are put there. Okay, thank you very much.